and what an exciting time we're having. The good news is that the Bank of Canada, again on January the 24th, left the rate at 5%. So, Michelle, tell us who you are and tell me what you think about what the Bank of Canada just did.
Hi, Sandra. Great to be here. Michelle Drover, Premier Mortgage Center. I'm thrilled. I think we're all thrilled, waiting with bated breath, as they say, but this is the fourth consecutive meeting that the overnight rate has held steady. This is really great news for anybody who has any sort of revolving debt and or mortgages. So good news. I think we're going to see continued pressure to keep the overnight rate steady. And then hopefully spring, summer, we'll start to see some reduction in that.
People talk about the market cooling off, and so it has cooled off. I mean, there's not a lot of listings out there. But what was interesting, when I did the stats, for 2023, I think I might have spent like 4 hours over like 6 spreadsheets. And there were 3,700 single family homes sold in Halifax. And out of that, 60, I believe, were homes that were under $500,000. So to me, under that price point, that's first time buyers who are coming out. I mean, what do you think, or what have you seen at Premier?
Yeah, I mean, look, there's no question that our properties have increased in value, as they should.
Yeah.
And yes, I mean, first time home buyers, look, you can't really buy anything under, I think you'll agree, like 450,000 anymore, unless you're going in the outskirts. But
Yeah.
that is definitely a sweet spot for first time home buyers, for sure. And I think that we're going to continue to see, and I think you'll agree, we'll start to see some more supply come into the market in the next couple of months. And again, appealing to those first-time home buyers. I mean, look, the average person is paying $2,300, $2,400 to $2,500 for rent right now. So if we get them into a house, we want to see that they can build some equity.
So you talk about inventory coming back to the market. I remember when I held a condo downtown and I had a variable rate when things were starting to fluctuate, and my payments were astronomical. Now, I realize that the stress test is there for a reason, and it's to protect the consumer when they're going to purchase. But do you feel that maybe some of the people who would have paid for a property during COVID would have bought at the top end of their scale, which they were still comfortable with, and they had money to go spend? And now the time is coming up for renewal, potentially. Where do you see that particular consumer, or what are your thoughts?
I mean, I see some strain. There's no question. I mean, you're going potentially from paying a 2 to 3.5% mortgage to potentially 5, 5.25, 5.5, depending on, again, the overall objectives in terms of that borrower. And if they're going to hold that property, what term are they looking at? So certainly you're looking at an increase roughly about 30 to 40% in terms of your overall shelter costs, mortgage costs. Having said all of that, if the individual has not incurred a lot of debt outside of their mortgage, I believe it's still manageable. I really do believe that. And I also believe that when somebody gets in their renewal statement, they can't just sign it. Don't just sign it and send it back to that organization. Reach out to your trusted mortgage broker, your trusted mortgage associate, because we're able to help navigate that renewal rate and new renewal process, but also really have a deep conversation and find out what your overall needs and objectives are and how we can help potentially increase your disposable income in terms of payment and shelter shock.
So let's just talk about payment shock, for example. So I just have a sample over here on my other screen. So if a client had a $400,000 mortgage and they had it at 3.5%, they had a payment of $1,997 per month. Now, when they're renewing, their payment is now $2,300 and change. So an increase of $325 or $329 a month. So that's $329. Yeah. So that's money that maybe you're not using to, I don't know, buy that nice bottle of wine or go out for dinner or put your kid in other sports. Like, so are you seeing people who are questioning that extra? Because for some people, let's admit it, Michelle, that's difficult, that extra $329 a month plus cost with everything else.
Absolutely. Listen, we know the cost of living is outrageous. We haven't seen this in many years. I'm going to say at least 2 decades, give or take. And certainly the cost of goods is higher, our gas, our food prices, utilities, tax rates, etc. There's no question. There is going to be strain in households. What I've seen is people are economizing. And so, as you just said, cutting out the extras, right? Cutting out maybe that dinner out once a week or maybe once a month, however way it looks. Cutting out the additional luxury items, if you will. Certainly it's a concern, but again, there are ways in which that we can work with our borrowers to ensure that A, they can stay on their property. B, they can do certain things to lower that monthly payment in
So
terms
just give
of,
me an example of that. Like, what can I do to lower my payment?
well, we could potentially look at increasing your amortization, which
Okay.
is the other thing is, Sandra, a lot of people do have outside debt. They may have several credit cards, might have a line of credit, and the average interest rate that most people are paying on those debts outside their mortgage is about 19%.
Yeah.
And so if we can take a look at our clients' overall financial situation, what their objectives are, we could potentially refinance and take some equity to pay down their debt so that they have one payment per month and maybe, of course, a car payment. But I think again, it's crucially important that we sit down and analyze everything about that particular client and borrower and their current and future needs.
You know, it breaks my heart. So I'm an avid reader of All Nova Scotia every morning. That's what I do. And I am so bothered when I see bankruptcies because did they have another choice? The choice to sit down with someone, a mortgage broker from Premier or wherever you want to be, and look at the options that would be in front of you. And then I think about, why didn't you sell your house? And then that you wouldn't have to go bankrupt. You would take that money, whatever was left, and not have that credit scar for 7 years. Like, there has to be more options than bankruptcy, yes?
Definitely. And there certainly can be. I mean, again, it depends on that person's overall circumstances. It could have been a multitude of reasons.
Oh, of
Maybe their
course, absolutely.
passed away, right? Or maybe they've lost their job or what have you. But I would always recommend that people get a second opinion. A lot of people think, oh, I'll just go bankrupt, or someone will say, oh, just go bankrupt, not realizing the long-term potential ramifications, as you just said, 7 years. I mean, we can talk to a borrower 2 years after discharge with everything reestablished, good savings, and potentially look at them purchasing another property. But as you just said, are they getting the right advice? Are they seeking out another opinion? And I think that's crucially important, Sandra, that
Oh,
we don't
absolutely.
just take the advice of what we're hearing on the street, right? We
True.
speak, we
And
speak to somebody. Yeah.
yeah, and so I don't know if I read this online or where I heard it, but let's say, for example, my mortgage renewal is coming up this year. Do I still have to pre-qualify for my mortgage? I don't know where I heard that you didn't.
Okay, so two things.
Yeah.
If you are renewing with your existing financial institution and they send you out a renewal agreement and you send it and sign it back, you just sign it back and send it in. No, you don't have to be requalified.
Yeah.
So
Okay.
that's important. However, having said that, typically the renewal statement that most people will receive from their banks and or trust companies or lender will have a rate that's much higher than what we can actually get them in the marketplace. And so the lender's retention rate, renewal rate is in the 90 percentiles because they're counting on their borrowers not to reach out to a trusted mortgage person, broker, associate to say, hey, look, what is available to me on the market? And our job at the end of the day, Sandra, is to ensure that we're doing the best possible thing for our clients and we're being their advocate. And
Yeah.
if we can say to them, look, if I look at your overall financial situation, we have a discussion, let's sit down and talk about this. I might be able to move you to improve your financial situation and get you a better rate and one that matches your needs and your objectives. There will be, however, qualification that will need to be done, and we will need to collect new documentation, but it will be worth your time. The
I
reality
agree.
is most financial institutions, Sandra, they want us to just sign 5 years. Like they just want us to take another 5-year term. And that rate could be in the high fives or early, let's call it 6.1 or 5.99. They want the client to lock into that because they make more money.
Of course.
I understand that people are concerned and they're worried that they may not qualify. We will tell you if it's the best thing for you to do is stay with that other financial institution. Any mortgage broker that's looking out for their clients' best interests and looking at their overall objectives, will definitely give the advice. And we often do that. We often say, look, you've got a great rate. This is where you need to stay.
Yeah. Now, do you think, I believe that consumer confidence is slowly coming back. The rate, as you mentioned, has stayed in place now. This is the fourth consecutive time. Do you see maybe third quarter, the rates maybe declining a little bit, or do you see us at 5%, like, because here we are?
No, I think, look, at the end of the day, it's all about inflation, right? So inflation has lowered somewhat. We're predicting a soft landing. Again, that's what we want. We want to go into a soft landing. We don't want it to be a hard landing. And if we do that, then of course we're going to have to pull back spending and pull back the economy in terms of raising our rates. And it's all to do with monetary policy. I really believe that if things stay the course, I believe we're going to see some cuts. Now, it may not happen till summer or fall. We could be pleasantly surprised, and it happens in April. I mean, look, March 6th is the next announcement, then April the 10th, then June, and then July. Definitely by spring, summer, I hope that we see something happening. Now, is it going to be a significant drop in the overnight rate? No. It'll most likely be 0.25% increments. And I would say the next year, 6 months to 12 to 18 months is extremely positive. And I would still recommend clients go into a variable rate mortgage.
You know, this is on topic, but it's off topic. Like, I was listening to the news and they're talking about the international student cap that they had, the foreign buyer ban for non-Canadians to purchase. That's supposed to stop in December 2024. I don't see that stopping. And because if they're just bringing in the international student cap, I believe that foreign buyer ban is going to exist well into 2025. I mean, that's just my prediction. And then so here locally, right, if you're from wherever in Canada, you're going to be charged an additional 5% D-transfer tax if you're not closing on a house within 6 months. And I don't see those things changing. So when I look at that and I don't anticipate that change, I was wondering this morning, like, are they really going to reduce the rate of the 5% or what they have right now? Or are they going to stay on par for the full year to see how it plays out?
I think there's two different things going on there. And I think that look, I mean, I hate to be political in my discussions, but at the end of the day, we have a housing crisis in this country. That's just the reality. And it was starting more than 10 years ago.
Oh, yes.
More than 10 years ago. And so here we sit today. And the government has put stopgap measurements in place, i.e. foreign ban ownership. Having said that, you can still buy a home here, but there are certain guidelines that you need to meet, right? So permanent resident, working full time. If you're outside the HRM area, you may qualify. So there are some caveats to that foreign ban ownership rule, which is a good thing. But I think you're quite right, Sandra. There's so many things that need to happen, right? So construction, labor force, where are we getting people to build the homes? Bureaucracy within our municipalities. They want to build up, not out, right? They don't want urban sprawl because it costs more money. I mean, we could have a whole show on this, right?
Yeah.
At the end of the day, I really strongly believe that we have three different branches of government. None of them speak to one another on this. So we've got our finance minister, we've got OSFI, Office Superintendent of Financial Institutions, which regulates the banks and lenders and puts in these guidelines such as the stress testing. And then we have the Bank of Canada. And the reality is our housing ministers, everybody's, speaking different language. No one is actually sitting in a room and understanding what the real problem is. So I don't see that impacting interest rates. I think that even with lower interest rates, at the end of the day, it's going to be a supply game.
But and you know what, you're right. And I go back to 2017 where I noticed a shift in the market, like stale product was selling. And I just saw that shift changing. And I believe COVID wasn't the catalyst to this. COVID may have exasperated what was going on in the market. But the issue is not the $700,000-800,000 homes that we're selling. It's the home for the average Nova Scotian that they can afford it. And that's the housing crisis. And for real estate agents, I mean, do we deal a lot with homes that are under 500,000? Well, I mean, 48% of the market, what just sold was that, but We have a lot of local buyers are out, and where was I going with this? But COVID just kind of just lit the fire, I guess. But you're right. It was happening a long time before that.
It was. And like, here's my take on this. I mean, I've been in this business for 34 years in July.
But did you start when you were two?
Well, I mean, I started pretty young, there's no question. And I've seen different business cycles and all kinds of wonderful mortgage and loan programs introduced. And then we shifted our government and interest rates, and with COVID, right? COVID really impacted interest rate like 2%. And so the government came in and they wanted to put some measurements in place, and that's great. We needed to do that. Having said that, where we are today, interest rates are sitting at, let's call it anywhere between 505 for a 5-year insured mortgage, meaning you're purchasing a property with less than 20% down, up to say 5.5%, 5.6. It's not a bad rate. Where the issue is that we're adding 2% on top of that to qualify our clients. So we're in an interest rate environment that is slowly normalizing, if you will. To about 2009, 2010, we had similar interest rates. We need to revisit the stress test.
I was just going to ask that.
We need to revisit it. Look, if the rate is less than, let's call it the Bank of Canada overnight rate, it's whatever that is. If it's less than that, then sure. Perhaps we need to add in extra qualification in terms of affordability for that payment. I don't have an issue with that. And I don't think most people would. But we also need to look at amortization. The average property that people are purchasing, they certainly outlive 25 years. So we need to look at helping Canadians get into home ownership that they can afford. It's a basic right, in my opinion, that we provide safe, affordable housing for Canadians. And so we need to look at offering a 40-year amortization, in my opinion, 35 to 40 years on an insured mortgage, as long as the underlying asset will last up to 40 years, right?
So I'm with you on that. Just one second. I'm with you on that. But the stress test, yes, the extra 2% that you got to qualify, I get that. And do you not think that the stress test is going to save some people coming up for the mortgage renewal because they know that we prepared them for that, we know that they can afford that?
Yes, I don't dispute the stress test. What I take issue with currently is that our interest rates are normalizing. We're not seeing 2% interest rates again, Sandra.
No.
So the need is not as great to have that 2% above the qualifying or the contract rate. If we're going to be sitting in an interest rate environment anywhere, let's say 5.75, happy days in a couple years, we've got 4.6 or 4.8. It's a normalized interest rate environment. Certainly, we needed to implement that at the time. There was no question. I think what happens is that our government, they're not listening to what the people need. And the profile of the buyer is changing. And I really believe we're going to see more people, whether it's friends purchasing a property together or two families purchasing a property together. I really see that coming into play because it's necessary. It's almost necessary, right? To combine households and to combine. And so I think that there's going to be I'm hoping innovative products coming into the market to help individuals like that. Again, I really believe the first time home buyer profile is changing.
Who do you think it is? Or just because it's going to be combined or?
I think, I have a nephew. I have two nephews. I don't think that they can afford to go out and buy their property. They both live in Ontario. I think they may have to look at buying a property with a couple of friends. I think that they need to be able to share their resources, sadly. So, but having said that, most people will stay in their home for 3 to 5 years. They can build equity together and then they can go buy a new property. So I'm hoping that there'll be more government programs to help Canadians. I hope that we can look at extending amortizations, and we certainly can today on uninsured mortgages with some of our lenders. So if a client's mortgage is coming up for renewal, they need more disposable income, we can look at restructuring all of their debt and having that conversation and looking at various payment options for them. So I highly encourage anybody who has a contract that's coming up for renewal to reach out so that we can do a very in-depth review. We're not here to judge. This is a
No,
non-judgmental, transparent environment. We're here to help people.
I agree. And so I didn't know what a mortgage broker was when I was first buying a house back. Oh my God, I was like 26 when I first bought a house. And the thing with a mortgage broker is that they can shop around, just like an insurance broker, to see which program is the best for you. And they're not committed to TD. If you're working with someone at TD, like they have 30 banks at their disposal to get you the right one.
That's right. I mean, look, at the end of the day, our job is to represent our client to the major banks and trust companies that we do business with.
Yeah.
And oftentimes there is no charge to the client. That's right. The lender pays the broker. And sometimes there might be a fee to the client from a lender, but we're talking about alternative mortgage solutions, meaning client may not qualify what we call an A lender or conventional mortgage guidelines. But at the end of the day, I was just helping a client of mine. Average interest that this young lady was paying was 19.97% on all of her debt. So, I mean, you can imagine she was drowning, if you will. And we had a great conversation. We're able to pay off all of her debt and keep her in her property, and her credit will remain excellent. So
Good.
these are things that we're able to do to help our clients, Sandra.
Oh, wonderful. Well, I can't wait to talk to you in March. Is it March, you said?
Yeah, our next date is March the 6th.
Okay. And let's see what happens at our market. And you know what? Let's review the stats because it'll be interesting just to see what's happening. And we'll have 2 months behind us of what's been happening here in our market. And it'll be interesting to see if the trend is continuing with my assumed first-time home buyers who are out. So that'll be interesting for sure.
Absolutely, Sandra. Thank you so
Perfect.
much.
Thank you.
I enjoy being with you to talk about this. So thank
Yes,
you.
awesome. Thank you.